if you look at some of the collapses we had Bear Stearns and we had Fannie Mae. Now Bear Stearns was leveraged into mortgages 30-1, so basically they had 30 times as much debt as they did have backed by assets. Fannie Mae's even more ridiculous. It was leveraged 129-1, and a lot of that was because of the derivative products which enabled that to happen. And lending at that particular time, especially in a boom, was just so easy to get. The problem is that we're starting to find out now that property doesn't always go up. A lot of times for these low doc loans, people were offered honeymoon rates where they were given a discounted interest rate to get them on board and entice them into taking that loan and taking on more debt than they should have. And that honeymoon period then started to run out, after 2 or 3 years, and some people had taken on much more debt than they probably should have, had trouble servicing their loans, so they started to default, and then it really created a chain reaction, because as people started to default, there was more supply, and that obviously reduced the more supply in property, and that reduced the value of property prices, and then more people came into trouble because when they went to refinance their property to help continue fund their lifestyle, they found that there was no money left in the property. Not only that, the honeymoon period was over, so the interest rate had jumped back up, and they were pretty much left with a huge debt that they just couldn't pay. So they started to default on properties, and that's what we're seeing now, and that's what's causing the property bubble to burst, and now property prices are just getting slashed. If we look at Detroit, home prices are down 80%, and I've got some interesting facts here that I was doing some reading on. Home prices are down 80% in Detroit from their peak in 2003, where the average price of a home in 2003 was $97,850. It's now an average of $19,448. And the strange twist of fate is that it costs more to buy a new car in Detroit than it does to buy a home. And that really is almost like a house of cards as it's starting to come down. It's like that chain reaction. The prices are coming down because people are defaulting, and more people are defaulting because housing prices are coming down. People really were just over leveraged. So that brings us to the idea that this house of cards is finally beginning to crumble. And I've put an interesting statistic I read up there, which is 1 in 105 US households have lost their home to foreclosure, default, or have a pending foreclosure. That really is an astonishing statistic, and no wonder people are getting scared and worried about what's going to happen. I also saw another statistic on Zillow.com, and they were mentioning that almost 1/3 of US homeowners who bought a house in the last 5 years now owe more money on their mortgage than the property is worth themselves. So as you can see there, that really is going to start to create a chain reaction where people have these huge mortgages that they just can't afford to pay, and that's going to continue to drive things down further and further and further. And as people start to default on their loans, what does that mean? That means second tier banks typically are the first to go. Those banks that aren't necessarily taking banking deposits from people that don't have the cash, and their whole business is built on lending of loans. And typically what they do is, the way these second tier banks make their money is they will borrow at one rate and then lend out at a slightly higher rate and then make the difference between. Now the problem when people start defaulting on their loans is obviously they're not going to have that cash flow coming in to pay back the loans. So your second tier banks fail, and then if enough second tier banks fail, then it's a chain reaction, and we start to see some of the first tier banks start to fail. And that's the situation that we're facing right now, and that really gets people quite scared for obvious reasons, because once a bank starts to fail, like typically people see banks as the safe haven for where to put their money, and if you can't rely on your banking institution to be able to pay you back, you know, what do? You think, oh, okay, if that's the case, I'm going to pull my money out of the bank and I'm going to put it under the mattress because it's safe under the mattress. But that creates what's known as a run on the bank, because the banks, as we know, especially with all this leverage and institutions being leveraged, you know, up to 130% to 1, these companies don't have enough cash to cover that. So as people pull money out of the banking system and sit on it because they're worried for, you know, they're fearful as to what might happen, and they're sitting on that cash, that creates further problems because, you know, there isn't enough money to go around there, especially while these banks and everyone is so hugely leveraged, and that's what's causing these banks to collapse and this house of cards collapse in on itself. So what's the government's plan then? Obviously the US government is wanting to step in to try and make sure that their whole economy doesn't collapse, and I read an interesting statistic the other day which mentioned that 7,000 homes a day are going into foreclosure. Seriously, that is unbelievable. We are in a huge state of crisis at the moment. So what was the government's plan to bail out the situation? They came up with an idea for a $700 billion bailout. Now, when you consider the fact that if you were to add up Medicare, Social Security, and all the US debt in total, it comes out to about $175,000 per person in debt. That is a huge amount of debt, and I think, you know, $700 billion is hardly going to even scratch the scratch of the surface of what's going on here. And interestingly, the government has already bailed some of the banks out in the lead up to this. They've already written off $563 billion in bad debt has been written off by the banks. So I don't know if another $700 billion is going to help the situation. It's a much greater problem than $700 billion can fix. Similarly, I think why this $700 billion bill bailout was knocked back was because taxpayers saw it as the taxpayer bailing out Wall Street, because obviously if the government's putting the money in, it's coming from the taxpayers, and you know, it's these Wall Street companies that have been vilified, and everybody's pointing the finger at, saying it's their fault that we're in the situation that we're in. You know, they were leveraging up massively, and you know, they were taking profits on all of the way up. How can we now, once the market turns, bail them out? We're sending the wrong message to Wall Street that, you know, make as much money as you can, and if, you know, the shit hits the fan, for lack of a better term, then it's okay. The US government is going to come in and bail you out, and the taxpayers really didn't want to do that. So that's obviously why it got blocked. But I'm quite happy, or think that it was a wise move that it got blocked for another reason, and it's that idea that you can't borrow your way out of debt. Debt got you into this problem. I don't think borrowing your way out of debt is going to get you out of the problem.